like to welcome you this morning to the 2013 George S. Eccles Distinguished Lecture. It's a great pleasure to see so many students and members of our university community here with us, and also members of the broader community of Cache Valley and Utah. Welcome to all of you. Past speakers in this Distinguished Lecture Series, which was started 40 years ago this year, have included a variety of different luminaries, including management guru and author Peter Drucker, Alan Greenspan, the former chairman of the Federal Reserve, and various Nobel Prize winners, including Milton Friedman, Gary Becker, and Ed Prescott. And today we welcome another Nobel laureate in economic sciences, Dr. Vernon Smith, as our 2013 George S. Eccles Distinguished Lecturer. We are grateful to have Dr. Smith here with us. And let me just make a comment about George Eccles before I turn the podium over to him. You know, George Eccles, the son of the great entrepreneur David Eccles, was born here in Logan and raised in this community, attended Utah State University for 2 years, and then completed his degree at Columbia University. And with his brother, Mariner S. Eccles, the first chairman of the modern Federal Reserve, founded and led the first security corporation, which was the largest bank holding company in the Intermountain West. George was deeply committed to this university and to its students. He cared deeply about economic education and business education, and he was a strong supporter of the College of Business, as it was called at that time. And you may have noticed that we are sitting in the main auditorium of the George S. Eccles building. The building was named after him. This lectureship was established during his lifetime to raise the economic literacy and business acumen of students at Utah State University, and it has been deeply important to him and to the Eccles family since then. We're grateful to have such a distinguished professor of economics as our lecturer today. Dr. Vernon L. Smith was awarded the Nobel Prize in Economic Sciences in 2002 for his groundbreaking work in experimental economics. I believe you shared that with Daniel Kahneman, did you not?
Yes.
He has joint appointments at the Argyros School of Business and Economics and the School of Law, and is part of a team that runs the new Economic Sciences Institute at Chapman College. He's been president and founder of the International Foundation for Research for Experimental Economists since 1997, and is the author or co-author of more than 280 articles and books on capital theory, finance, natural resource economics, and experimental economics. He has served on the board of editors of numerous premier economic journals, and I think you've got on the back of your programs today a more complete biography of Dr. Smith. He did complete his undergraduate degree in electrical engineering, so if we have any engineers in the crowd, it's not too late for you. You can still get advanced degrees in economics. At Caltech University, his master's degree in economics at the University of Kansas, and his PhD in economics from Harvard. Dr. Smith, as you might imagine, has been invited many times to speak throughout his career, but he's been, since his Nobel laureate, absolutely inundated by speaking invitations. He has said that people tend to exaggerate the prize out of all proportion, quote, to the point where you are very aware of people looking at you no longer as a human being that you are. I'm expected, he said, to be an authority on all matters from God to man. Well, we've asked him to talk on a more restricted subject today, that being the recessions since 1929, and in particular the role of housing in those recessions. He's joined with us today by his wife, Candace. We're delighted to have her with us here. He's no stranger to Utah, having owned a home in Monticello and having been all over the back trails of Utah in his Jeep. So won't you welcome Dr. Vernon L. Smith as our speaker.
Thank you very much, Dean Anderson, for that wonderful introduction. Yes, I love Utah, and I seize opportunities to return. I want to say, though, that and I want to thank Randy Simmons for originally inviting me and for hosting my wife and I on this visit. I've known Randy for more years than I would care to remind him, so I won't. Anyway, it's a great pleasure to be here. And I want to say that most of what I want to talk about I have learned in the last 5 or 6 years. And it's, I'm going to borrow a page from Ed Leamer. He's one of the few people around that agrees with us that housing is the root of a lot of evil in the economy. And Ed always starts out and he says, the bad news is that I'm not a macroeconomist and I'm not a monetary economist. He says, the good news is I'm not a macroeconomist and I'm not a monetary economist. So anyway, I'm going to borrow that page from Ed Leamer. My background, as I think you all know, is in experimental economics, and I'm going to have a chance here, I think, to bring that perspective a little bit. I can't spend too much talking about that, but there's a couple of places where it's sort of relevant, and I will mention it. So here's an outline, and I'm going to do it in the form of sort of a series of propositions. And the first one is that I'm going to talk about the Great Recession as what I call a household bank balance sheet crisis. And I'm going to show you a couple of slides there, and I'll be able to make some commentary there on their relation, how experiments are related to at least one of those slides. And then the second proposition is that the Depression was a household bank balance sheet crisis. And then proposition 3 is that housing is the U.S. business cycle. It's new housing expenditures is a leading indicator of 11 of the last 14 recessions. And the bookends of those 14, the first is the Depression, and the last is the Great Recession. And of course, those were far worse than any of the ones in between. And then proposition 4, I want to talk about, kind of contrast stock market crashes with housing bubble crashes, because it's important to see the difference. And this explains why it is that stock market crashes do not bring recessions. And then finally, I want to talk about achieving what I would call escape momentum from recessions when there are lots of damaged household and bank balance sheets around. Although we don't know much about what to do in the positive sense, we kind of know what doesn't work. Monetary policy doesn't work, and also we have learned with the massive disappointment with the episodes of deficit spending, first by President Bush, followed even larger by President Obama, that they don't work. At least they certainly don't live up to anything like the expectations that we had. And I want to talk then about alternative responses. None of these are painless, but they provide, I think, some insights and lessons. And the first is I want to talk about bankruptcy and default as a balance sheet repair and reboot process. Public policy tries to avoid bankruptcy and default. And as a result, we fail to get some of the therapy that comes from that, because it does reset balance sheets so that you get rid of negative equity and and gives the system of a chance to escape from that black hole. I think of it that way. And then I want to talk about the alternative of protecting incumbent creditors and investors from default. That's politically very popular. It's the Japanese model, and I'll talk about that. It's the US model. It's the too big to fail model. And so I will, and of course in Japan is the longest and saddest experience with that model. And then I want to talk about, finally, market currency depreciation. This occurs, there's a couple of dozen smaller countries around the world that have been hit by these major crises. And an important part of their recovery was market depreciation of their currency. And so they recover through a surge in exports. And I'm going to give just two examples, but I could easily give you 24. Okay. So here's the first proposition. The Great Recession is the household bank balance sheet crisis. Now here is a chart and I'm of the build-up to the Great Recession and the collapse. And I'm going to show you, there's going to be other charts very similar to this. So I want to kind of explain how Steve Gierstadt, he's my co-author, he and I, we just sent a manuscript to Cambridge University Press on rethinking housing bubbles. And this is a typical chart from that book. Okay, what we're charting here is C is non-durable consumption expenditures. Think of hamburgers and haircuts. Okay? These are basically perishables, mostly services. So we have a chart of that. GDP, consumer durables, we separate consumer durables from the perishables and chart those separately because they behave differently. Non-residential fixed investment, that's business investment, I, and then housing investment, and that's annual expenditures on construction of new homes, single and multifamily homes. All right, now this chart, everything passes through the first quarter of the Great Recession when it started, okay? And that was the fourth quarter of 2007 was the first quarter officially by the National Bureau of Economic Research who makes these decisions. That was the beginning of officially the recession. So all of this data is plotted as percentage deviations from that anchor point. Think of that. Okay. So here's housing expenditures that begins, what is that about? Here we're nearly 80% above that level. 1, 2, 3, 4, 5, 6, 7 quarters before the downturn. Now that's a pretty long lead time, right? Lots of lead time. Well, I'm going to show you data later that show you that that's not unusual to get a pretty good lead time in terms of new housing expenditures. That is the most unstable component in the national accounts, if you go back, including the Depression. It's highly unstable. By far the most stable component is C, non-durable. That's the hamburgers and haircuts. This, by the way, is by far the largest. If you subtract government expenditures from GDP, you get basically gross private product. 75% of private output is essentially like hamburgers and haircuts and hotel rooms and passenger seats and airplanes. This stuff that you cannot store and is not retraded. The fact that it cannot be retraded is the secret to understanding its stability. As soon as you can retrade stuff, especially houses, then you can have people buying and selling based upon expectations of prices. And the key there, and we've got experiments that kind of demonstrate this in the lab. Now, those of you who are familiar with my first laboratory experiments, going back actually the late 1950s. The first paper was published in 1962. Those were basically perishables. I never thought of them in those ways, that way. You see, the Great Recession has given me a new perspective on my older research. Because in those experiments, if a buyer bought from a seller, they immediately realized the value from that. Okay? And they couldn't retrade them. Before you went to market, you already knew whether you were a buyer or a seller. That's like hamburgers and haircuts. Okay? And you repeat that. In those early experiments, I repeated that. Wow, did those markets, people not knowing anything about supply and demand, would converge very quickly on the equilibrium of the supply and demand. I knew what that was because I knew the distribution of values and costs that people had received. So, so here, 2007 and 8, I'm getting a perspective I didn't have on those first experiments. Well, then in the early 80s, we started to do our first experiments on what we called asset trading. And wow, we were getting bubbles in situations where people, we would tell them what fundamental value was. That is, we had an environment where they paid no attention to that. Anyone that thinks that people in experiments want to do what the experimenter wants them to do, need to look at that. They were paying no attention to the information we were giving us. And we were getting bubbles. And so a program of experiment that had started with the idea, let's begin with a baseline, so transparent that everybody would trade at fundamental value, and then let's see if we can create bubbles. We were already getting bubbles. And the problem was why. And by the way, we still don't know why it is that human beings get caught up in self-reinforcing expectations of rising prices, but they do it. And it's one of the oldest stories in economics. Tulip manias, the South Sea Company bubble, Florida land bubbles in the 20s, Chicago. My colleague found data on, they first platted out downtown Chicago in 1936, 37. The lots were up for sale for $50 a lot. They got bid up to $1,000. There was a big bubble there on those. So this story is not new. It's very, very old. And so, so you see here, we go into recession, and it's primarily coming. The precipitator here is this crash of housing values against fixed debt, plunging households, a lot of them into negative equity. And then you see GDP falls. These non-durables, they track GDP very, very closely, and if GDP turns down, C holds up even better. That's a very common story. Most people learn that the first couple of weeks of a macro class. All right. Okay. Let's go on here. This is the inflation-adjusted price of houses going back to just before 1940. And this chart kind of gives you a dramatic indication of how spectacular this housing bubble was. Notice we had two previous bubbles. One peaked here in 79, and this one peaked in 1989. And notice that these bubbles, they kind of look like the Henry Mountains. in Utah. They don't look like a Matterhorn. Your Wasatch look a little more like this. Okay, they're rounded. It's interesting that our bubbles in the laboratory tend to look like this. You don't see this very often. Notice that prices are rising at an increasing rate. The slope of that curve is getting larger. That's really pretty spectacular. And already, although the late stages of that bubble, for example, in 2005, 45% of first-time home buyers paid no money down. 45%. Well, that's way back up here. We were already to a historical high by 2001. This thing already had a head of steam before we had a lot of those practices that people have been so critical of that were coming into being. And was it momentum driven? Well, I have a colleague that I've published some papers with, Gundas Kajanel. He's a mathematician at the University of Pittsburgh. And he has a model of bubbles based upon the notion there are two, he hypothesizes two kinds of investors. Fundamentalists who buy on fundamental value. They buy in proportion to the discount from fundamental value and sell in proportion to the premium. That's one type of investor. The other one buys in proportion to the rate of change in price. And that's the momentum component in his model. And if you have, anytime you see prices rise, an asset prices that are rising at an increasing rate, that in Gundas's model, that strongly suggests momentum in the sense that people are in there buying. Why are they buying? Because prices are going up and they expect them to continue to go up. Okay. Now, this is the flow of mortgage credit. And notice that there's a surge in that credit here that peaks out around 79, and then another one, 89, falls, and then it starts up, and we have this huge surge. So we're talking about a bubble that's basically fueled by what Adam Smith called other people's money. As far as I know, Adam Smith in The Wealth of Nations is the author of the phrase other people's money. And so I'll be referring to OPM in honor of Adam Smith. So a huge amount of credit is flowing into that market, which then, when it collapsed, it collapsed along with the bubble in prices. This is a chart of the value of the value of the entire stock of U.S. homes, okay? Kind of real estate assets, and that's basically single and multifamily homes. Here is debt going up not quite as fast, you'll notice, as the value, the mortgage debt. Here is the difference between those two curves, which is household net equity in the aggregate. Notice that turns around in 2006, and in 2007, the value of the entire stock of homes is starting to fall because of that collapse in prices. But notice what debt is doing. It's continuing to rise in 2006. It's even eking out a small increase in 2007, and then gradually it's starting back down. So the value of home assets is falling against fixed debt, and that's what puts households, so many of them, in negative equity. So you see here, when the equity starts to fall, it's falling right in step with with the value. Oh, and notice here, household equity is peaking out here, what, about $13.5 trillion in 2006. It falls to about a little less than 6, below what it was in 1997. You're talking about 15 years. And the net equity has gone clear back to what it was 15 years ago. That's why the Great Recession is so painful. Okay? And this gives you kind of a little more disaggregated view of it. This is the survey of business consumer finances conducted by the Federal Reserve. And what I'm showing here is the percent increases from 2004 to 2007 in income and in net worth. And we're contrasting the change in the median and the change in the mean. Now, the median has the property, there's just as many above as below. Okay? So when you have from 2004 to 2007, the mean going up 8.5%, but the median not budging, it means the upper half of the distribution is getting everybody's getting an income increase, okay, almost everyone, but the upper half is getting a larger percentage. That's what that means. And then here's net worth change. Notice there the median went up quite a bit more than the mean. So that's almost all housing wealth. From 2004 to 2007, the so-called middle class, median, a lot of the people below the median were very much benefiting by those programs that we brought to subsidize and to get people of lesser means into a better wealth position by getting them to buy a home. Okay? So those programs seemed to be working from 2004 to 7. But look what happened from 2007 to 2010. In terms of net wealth, the median fell nearly 39%. All of that increase was given up, and it's going clear back to levels not seen since the 1990s. The upper part here was falling nearly as much as they went up. Now, I didn't mention, I think a fairly key thing that happened, I think it was on that last slide, but I didn't mention it, the price slide. In 1997, Bill Clinton got through, accepted, and was extremely popular. Democrats loved it, Republicans loved it, Libertarians loved it, everybody loved it, and that is you no longer have to pay a capital gains tax on your home, up to $500,000. In other words, you could take a capital gain as much as $500,000 and never have to pay a tax on that. Enormously popular. I don't think it's any accident that the bubble started in 1997. You can't prove it, okay? But when you take one asset like that and really sweeten it, you're going to make it tax-free for most people. You would expect money, funds to flow into that asset. So I think that's very much what has happened here. Okay, now the Depression. Okay, here's a chart very much like the one I showed you for the Great Recession. Here's the 29, the first year of the Depression. And here's housing expenditures. So it rose nearly 60%, flattened out, and it fell. This is 1929, so it fell in 1928. 1929, it fell for 2 years. In the Great Recession, it fell for 7 quarters before it, okay? And then here was this, and then bottoms out, clear down, 1933, recovers in 1934. I remember 1934 very well. My parents lost their 160-acre farm in Kansas to the bank. I look back on that now and I think, wow, good riddance. We started over. It was very painful at the time. But imagine, I think back and I imagine, suppose that a bank had come around and said, well, we'll stretch that out for you. Okay, you can stay in that farm and we'll stretch that out. We'll stretch your loan, we'll give you a lower rate of interest, and you can carry that ball and chain now for 20 years. Well, you see, that's the problem. That becomes a ball and chain for the economy, you see, when you do that. And the economy, by the way, you had, in 1934, the economy, GNP, grew 7.7% from its. Well, 1934, that's year 5 in the Depression. What's year 5 now? That was last year, 2012. This is the 6th year. Is anyone looking for a 7% growth? No. So now, it's true the Depression was much worse, the impact on output and the impact on employment, but it's not clear with all of the things we've done that we just haven't stretched that out, kicked the can down the road, okay? And we'll see how it plays out. All right, and here's the flow of mortgage credit. It tripled also in support of that housing boom and then crashed. The flow of mortgage credit, you see, became negative here between 1930 and 31, turned negative. That means people are paying old loans off faster than new loans are being made in the mortgage market, okay? It didn't turn positive until slightly here in 1938. So that was a long, dry spell, and we still got that same sort of problem with us in the Great Recession. Okay, now here is assets, debt, and equity from that period of the 20s and 30s. And notice it's not as bad as the Great Recession. You have a pretty big hit in the value of all homes. And here you have, you see, debt very reluctant to change, and most of the impact coming on equity. So you see you have equity falling by about a third by this measure, and that means a lot of people, a lot of the homes that had only recently been built by debt would have been particularly hit even worse than that by the decline. All right, now Proposition 3, housing is the U.S. business cycle. Okay, now let's look at that. I'm going to show you basically one slide that kind of illustrate that. This is new housing construction expenditures as a percentage of GDP. So here you have here's this big run-up, 1925, 26, and now this is a percentage of GDP, so it's a little bit different chart than the other one, but still it's very, very close. So you have this big crash, and then the recession starts here. And as soon as we get to the white line, the recession's over. Notice that housing is coming back. And moreover, that will be the common pattern. As soon as you get out of the recession and you're getting into the white part, housing is coming back. The only exception is this one, the last one. The common pattern is for housing to be very much a part of the recovery. And my guess is the reason why it behaves differently is you had this really quite a massive easing of money and the stimulus, and that has sort of blunted that that decline, and it's not clear that we haven't just sort of stretched out a lot of those problems. Now, I should mention here that if you count them up, you see very commonly this leading indicator like this. Now, sometimes there's some false positives. That is, the housing market is predicting a recession and it doesn't come until at least much later. Well, there's two of these, the Vietnam War and the Korean War, were very important, made important differences. And you can explain the failure to go immediately into recession in the fact that there was a substantial increase in government spending. Of course, that lends to the argument that government spending can keep things going. But these are not episodes where you had lots of damaged balance sheets. Okay? Yes, there's a trade-off. Government spending will do things if you don't have a lot of damaged balance sheets all over the place. It does work. And in so now this one, housing, was not an issue here. This is one of the exceptions. There was this short recession. This came on the heel not too long after the dot-com crash, but it was mostly investment spending that was lagging behind. And in fact, we had a period of very easy money here under Greenspan because he was worried about business investment lagging, and he was trying to kind of kick it along. But the easy monetary policy seems to have very much helped fuel the housing bubble. All right, now here, to give you a contrast with the Depression and the Recession, here is housing asset value, debt, and equity for a number of years here in the post-war. We have two of these for that entire post-war period, but this makes the point. You don't get anything like, in none of the minor recessions do you have anything like the bump that you have in the Depression or the Great Recession. This one was pretty bad. Okay, you had a pretty good decline of value against fixed debt, and it hit equity. But generally, you see the recessions are not being. So what that means is that lowering interest rates is effective in bringing the housing market back. So the Fed doesn't really kind of lose control through monetary policy of getting the economy going, and the mechanism is housing. Now, Ben Bernanke will tell you, and it is true, that the Fed does not deliberately target any particular industry. Well, no, but if they are lowering interest rates, you can't help but affect one industry more than any of the others, and that's housing, because so much housing is bought by credit. So although that's not a deliberate part of policy, it's inevitable that if monetary policy involves massive easing, it's going to affect housing. Okay, now why stock market crashes do not cause recessions? Well, the basic idea here is that stock market excesses are constrained by margin requirements. And think of margin requirements as property right rules. I think of I don't like to use the word regulation. I prefer to think in terms of property rights, because regulations always have to do with property rights, what actions you're allowed to take and what you're not allowed to. No market can function anywhere without a property rights system that provides good incentives. Okay, so there's Regulation in the sense of property rights is very common, and the important thing is that those property rights provide good incentives for people to do for themselves. When they do things for themselves, it's good for everybody, okay, because they help the system. And when those property rights are contrary to that, when they're not compatible with kind of what you would, kinds of outcomes you want socially, then the outcomes can be bad. Okay, now what these property right rules do is limit in the stock market the use of other people's money. And this wasn't just government regulation. This started in the private sector beginning in April 1928, and that's a year and a half before the stock market crash. You already had brokers and banks began raising minimum margin requirements, and the common requirement was 50%. It had been more like 25% below. It was much higher. That was Dow Jones stocks. It was much higher on more speculative stocks, 80 and 90%. So that happened, and then later the New York Stock Exchange started to require it of all of its members. That was in 1933. And then the SEC Act codified it in 1934. That's a nice, I think, way for a set of institutional rules to get in there, where there's private experience with it, and then there's a well-known public institution like the New York Stock Exchange recognizing it, and then it getting codified in law. Well, that very much limits the use of other people's money when you're buying stocks. And the other important feature about stock market debt is it can be called. So if you have a brokerage account and it's a margin account, you sign an agreement with your broker to always keep enough margin, cash in that account, that you don't fall below the minimum required. And you'll get a margin call. If your stocks fall and you've borrowed to buy some of them, you'll get a margin call. That means put up more money. If you don't put it up, he sells your stocks for you, or at least some of them. He's authorized to do that. And now what all that means is that the debt gets marked to market as you go, unlike household debt, okay? And here's a chart that shows that. This is Dow Jones average, and here is stock market debt. Notice here when we have these big declines in the stock market, the debt goes down with it. Here's a big decline here, the debt goes down with it. So you don't have values crashing against fixed debt impacting somebody's balance sheet. So you keep the thing, those balance sheets are getting cleaned up as you go. And that's the difference between crashes in stock market crashes and crashes in housing. Now, of course, you can't, I'm not arguing that mortgages be subject to call, but it can't be the same. But I think the learning from this is that what you need in housing markets is a bigger cushion in there and more protection against downside risk, especially when housing prices are growing faster than people's incomes or rentals or anything else, and it's being fueled by funny money. Okay. How to achieve escape momentum from recession? Well, let's look first at, I claim here, not with monetary expansion. Now, some inflation might help restore balance sheets, but you can't get it. I think the Fed would have loved to get some inflation in the last 5 years. You hope to bring up housing values, and also that reduces the real value of people's debt if you get some inflation, but you can't get it. And I think government deficit spending tends to fail for the same reason that monetary ease fails. And why? Because there's too many low, zero, or negative equity balance sheets. okay? And as I said earlier, I think World War spending, or maybe I haven't made this yet. Well, I was interviewed earlier before this, and I made the point, okay, that World War spending didn't start up till 1940, and it's usually thought, well, that's what brought us out of the Depression. But that was, you'd had 10 years of balance sheet repair. Okay, people had been paying down, gradually recovering. Remember, the flow of mortgage credit had turned positive in 1938. So we were gradually getting out of that. And so there's a point eventually where government spending will start to behave differently. Okay, 3 recovery responses. None are painless, so the thing to do is try not to get in this situation in the first place. Okay, think of bankruptcy and default as a balance sheet repair, reboot process. What do? Well, you mark bank mortgages to market. As the market falls, you need to revalue those. You lower payments to support reduced market-based principal balance if the borrower can pay. Otherwise, foreclose or short sell the house. That cleans up those balance sheets, okay. The banks recapitalize through private markets, downsize them as required, zero out the equity, bond haircuts. If there's bonds outstanding, they have to be part of that resetting process. This is essentially what happened over at the FDIC for 440 banks from 2008 to 2012. Read Sheila Bair's book, Bull by the Horns. Sheila Bair was a chairman of the FDIC until 2011, and she presided over about 380 of those, and that's a really good way to see how that process works. So a lot of small and medium-sized banks in this country had their assets remarked to market, sold off. Sometimes some of the banks survived, some of them didn't. All those balance sheets got cleaned up. And the advantage of that is that any new capital that flows now into the banks and into investment supports new lending undiluted by the claims of old old investors. Okay, because you see, if you try to save those incumbent investors, then any new return to new investors is going to be diluted by rebuilding or giving a positive return to the old investors. Okay? What failure does is it takes those incumbent stockholders and bondholders. You know what? You took your risks. It failed. We clean that out, and we set the stage now for a flow of new investment into activity. Okay, now the process we've tended to follow is more like this. We carry bank mortgages at the face value. Borrower makes full payment if at all feasible. If not, lower the payments by lengthening the loan term, lowering interest. Okay? This just stretches that all out, but you're still carrying that debt load. And so now Bank of America and Citibank were the two prominent large banks that we bailed out, and I think it's very interesting that if you look at their common shares, they sell for about 70% of book. Wells Fargo sells for 148% of book. In other words, healthy banks usually sell for well over book value. Their common shares sell for well over book value. And I think what the market is saying with Bank of America and Citibank is they're not sure those books are telling you what the profitability really is. Okay, now everybody wonders, well, are we finally going to get out? Well, I'm sorry. It's hard to say. We don't have any experience, okay? So, Here's the Japanese model. House prices peaked in 1990. They fell 25% by 1992. By 2004, they had fallen 65%. The government response, allow banks to make support loans to distressed borrowers. Banks increased the amount that they lent borrowers so that the borrowers can make payments on the old loan. Now that's the ultimate kicking of the can down the road. Okay? And this is, they stretched their write-down. They didn't have to take loan losses for, you see, over this 12-year period. And the objective was to allow the Japanese banks to offset their losses on bad loans with earnings from sound assets. Okay? Everybody expecting now that things are going to recover. We're going to start to get earnings, and we can, these banks will be able to recover. Well, that recovery never arose and never arrived. So, and here's a chart for the banks. For the Japan, and I want to, and it kind of indicates the macro consequences, I think, of that. Notice here that this is real GDP, inflation adjusted in Japan. This is going from 76, and notice that there's a kink in it here around 1990, 91, and this very rapid growth now becomes a much smaller rate of growth. All right? Did they try fiscal policy? Big time. Here's government revenues actually declining over this period, and here's government expenditures. So there's been plenty of expansion. It's a good test of the hypothesis that you can get things going if you just expand government deficit financing. Why didn't it work? Well, I think it's because the banks were stuck and households were stuck in this negative equity position. All right, let's see. Doug, do you want to stop for, I've got a couple more slides about, shall I finish? Yeah. Okay. Let me show you two countries, Finland and Thailand, that'll give you an idea of the kind of recovery scenarios that you see, that we've seen over and over again in small countries around the world. And it didn't happen through monetary or fiscal action, but primarily through the market tubing the currencies of those countries, and that setting the stage for just a huge growth in their exports and recovery of the real sector. Now here's Finland, and again I'm still charting things here based upon this is 1990, the beginning of their long recession. So here you have, and this is housing and business investment both declining substantially, and it hits GDP. Notice government spending continued to rise, but that didn't appear to be helping to recovery. What really made the difference is that the marka, the Finnish currency, you see, went from around 6 to 6.5 euros per marka to 7, and then the red here is exports from Finland, and notice that they're below imports most of this time. With that depreciation, now exports started to surge. Imports also, typically, both imports and exports go up with depreciation. And the reason is that an awful lot of the exports are imports. You're doing some assembly of stuff, and you're importing a lot of stuff for it, and you're turning around and exporting. So they may both go up. So typically trade here expands. But this surge in exports relative to imports, you see, started to bring the economy back. And that's been an important mechanism of recovery in these countries. And here's Thailand. And they, of course, what the central bank tries to do is peg the exchange and keep it from depreciating, but they were overwhelmed, and the currency depreciated substantially, and that immediately started in Thailand, caused exports to surge, and the economy came back as GDP started to grow. But it really wasn't coming from government spending. So, very brief summary. What's the problem? Houses are highly durable. We often build them with credit in excess of our growth and earned income. What Adam Smith would say was too much of other people's money. So thank you, ladies and gentlemen.
Dr. Smith has agreed to take a few questions. We have about 15 minutes, and I want to exercise the first prerogative of asking a question. And I don't know if you've looked at Germany, but my understanding of the German housing market is that they never really experienced the bubble, the run-up in housing prices. I'm wondering, first of all, is that true to your knowledge? And second of all, would that have had an impact on the fact that the German economy did not seem to be as hit as hard as the rest of the economies?
I can't really, I haven't followed Germany in enough detail to be able to answer that specific question, but I do understand that in Germany, the rental market is much more important. People, I mean,
right.
there is a tradition of renting apartments and houses. Apparently, the American dream didn't get to Germany. Yeah. And I would say, you know what? That's a very nice tradition.
Yeah.
You don't have to run out and buy a home. You can rent one.
Very
you
good.
See, let your landlord deal with this problem.
Yeah. Let it be his balance sheet that has to be corrected.
So, actually, Candace and I have owned a home in Tucson for a number of years. We leased from the university at Chapman. And when I was at George Mason University, we were renting an apartment within a few blocks of my office there in Arlington. And then we decided to buy a condo in 2004. And so we moved 2 blocks away from the apartment we were renting to another. It was a nice condominium. And then 2 years later, and we were, of course, traveling a lot. And 2 years later, these prices were going crazy. And so Candace and I thought, let's just sell this house and go back to renting. So we did. So we held the apartment for Bill Clinton's 2 years minimum holding period. And you see, we were part of the problem. No, that's exactly. And so, but we thought this is crazy. So why do we own this place when we're perfectly comfortable renting? So we sold it and moved back into a rental property.
Well, that disproves the old adage that I learned first sitting in these classrooms from my professor of economics as an undergraduate, who said, well, if you study economics, you won't get rich, but you'll understand why you're standing in the unemployment line. But in this case, you did get rich. Let's open up the floor to questions. Who'd care to ask another question? Yes, sir.
Dr. Smith, back to the Japanese model, with the recent change and obvious devaluation of the currency there, what do you see playing out there? Is this going to be successful or not?
Steve Gerstadt, my co-author, and I have been following that very closely because you see that actually they followed easy monetary policy earlier. and you've had a lot of balance sheet repair in the meantime. And the question is, why is it working now? Well, of course, is a deliberate attempt to depreciate the yen to help their export market. And so far, it appears to be working fairly well. I noticed there was a piece in the Wall Street Journal in the last week that Toyota in particular has been a major beneficiary. Their bottom line has really improved a lot based upon this depreciation. Nissan and some of the other Japanese automobile manufacturers have not benefited because most of a Toyota is domestic input. See, Nissan builds them here. I hadn't realized that about the difference. Some of you may know the automobile market better than I do, but apparently the domestic content of Toyota automobiles is larger than many of the others, so they're going to benefit the most from a depreciation. If you want to speculate where there's a depreciation and you're figuring the country is coming back and you want to invest in that country, you want to pick industries that have a large proportion of domestic. In Thailand, wood products, because that's they're not importing those to re-export them. And the same thing in Finland. You know, wood products would be an example of something that's has a large domestic component in the exports. So when the depreciation comes, you see, an export firm, their prices just rises in step with that depreciation. It's just like a huge windfall, you see, and they right away start to expand output as that price sweetens, and that means if there's some, and their banks, you see, are eager to loan to them, so that the whole system can get, it can be, the spark can come from that export market that can then spread to other industries and give you recovery. That's a very common mechanism among these smaller countries. We have, the United States, we have what I call the curse of a reserve currency. Everybody wants to hold their money in a dollar. And that accounts for our huge trade deficit because we have this big inflow. You see, everybody wants to invest here. So as a result, we have this large trade deficit. And in fact, that coupled with our minimum wage laws means that where the product where the output demand goes is to the Pearl River Valley in China. You see, the problem with minimum wages is they're very easy it makes it very lucrative for the products that are used with relatively unskilled labor to be imported from foreign countries. In the Bush stimulus, I remember a good many of the checks that went out would have been in April and May of 2008. Look what happened to sales in Walmart in April and May. They jumped up. So China buys our bonds, we issue more bonds. we write checks to people and the money goes back to China. And you know, one of the sad things about, and of course a lot of people, I understand, a lot of people like minimum wages because they imagine that this helps people of modest means. It helps you only if you have a job. If it makes it harder to get a job, you haven't been helped at all. And unemployment in this recession, what's the group that's been hit by far the worst? It's black teenagers. unemployment has just soared among black teenagers. The second largest kind of identifiable condition that has led to, or group that has suffered under unemployment, by unemployment, and this has been high school dropouts. The third is college dropouts. Those are the, well, you see, you want to make it easy to get entry level into the job market. You don't want to make it hard, because it's very important to get started. You know, I went to work in 1939. I was 12 years old, and I went to work for Mrs. Blackburn at the West Side Drugstore in Wichita, Kansas, delivering on my bicycle. And in the summer, I worked from 6 p.m. until midnight. I got 50 cents for 6 hours work. Boy, I loved it. What an opportunity. For the first time, I was earning. The other way I earned money, you could get a half cent a pound for old papers, and you can get 7 cents a pound for rags, old rags. So I was a paper and rag collector. That's the way, as a kid, you made money. And the other thing you made money is find Coke bottles or beer bottles, because the deposit was 2 cents. Why was there a deposit of 2 cents per bottle in Coke and 2 cents on a beer bottle? Why was that in the 1930s? Can anyone tell me? How many think it's because there was a law? No, there was no law. It's because it was cheaper to recycle the bottles. And Coca-Cola and Muehlbach beer out of Kansas City and Budweiser, these beer companies paid 2 cents if you bring the bottle back. And so I worked at the West Side Drugstore, and we had soft drinks, we had bottled drinks and beer, and the guy that would deliver cases of beer and cases of Coca-Cola and everything, he'd bring them in, and he would take back out of the truck the cartons full of empties. That's the way it worked. And so there was a huge recycling. Well, some people would still throw them away. Well, kids would pick them up. So that, and I'm very grateful for the fact that I was able to start to work early, because what I learned was the importance of serving the customers of my employer. Because if I made Mrs. Blackburn a success, she would pay me more. I actually ended up going to I learned to operate a fountain, and then I went to work and managed a fountain when I was 14 at a drive-in. So I got started, and I look back on that, and that was very important in my whole education and development. And it's just sad that it's so hard for young people now to do that.
You mentioned earlier that it was good, in retrospect, that the bank closed on your farm.
Yes.
The 160 acres. Let me just ask you to speculate on this. Is there a chance that had the bank not closed on the farm, you might have ended up as a farmer rather than an economist?
No, we were not very good farmers.
Okay.
We lived on the farm 2 years, and it was an investment. My mother's first husband had been killed. He was a fireman on the Santa Fe Railroad, and he was killed instantly in a train wreck, and she was widowed with 2 young daughters. I think Billy and Eileen were 3 and 1.5. Yeah. And then later, several years later, she married my father. And so I had these, as a result of Grover Bougere was his name, of his death, there was fire insurance, there was life insurance payment. Mm-hmm. So my mother had She worked selling shoes. She had a job. She went to work and everything. But she did have some assets that, of course, we never would have had because we were too poor. And so that money, I don't even know, because I wasn't born until 1927, but I know one of the things they did with that was to invest in this farm about 45 miles from Wichita. And we moved there in 1932 because my father lost his job at Bridgeport Machine Company as a machinist. And we lived there from 1932 to 34. And for me, oh my gosh, it was the most wonderful thing that could possibly happen. Cows and chickens and hogs and fruit trees. And so it was a great experience for me, but it wasn't a good time for my parents.
Other questions?
Yes.
Mike?
We've been talking about the balance sheet effect of housing bubbles bursting on households and banks. But during the Great Recession, the Great Depression, housing sales or house sales declined faster than house construction. At least in 1929, there was a huge stock of unsold houses, so speculative building by contractors. Would that also play into this scenario?
Well, yes, except that you see what happens is that the producers, when those prices start to fall, they will cut back on their production to keep their inventories in line, because most builders of homes can't really carry. They don't have the money it takes to finance homes and carry them for a long time. So they tend to cut the price and move them out, but after a lag. They don't cut them right away. Nobody does. Anyone puts out on their house, say an existing homeowner, you put your house on the market, you're looking at these last prices and you try to get the best price you can. And so prices always come down very slowly. And by the way, we get that in asset trading in the laboratory. In the gasoline markets, they have a name for this. It's rockets and feathers. Gasoline prices go up faster than they fall. It's not some kind of a conspiracy. The subjects in an experiment do the same thing. You're just reluctant to cut price. And so you hold the price. And so what people will do in the housing market is to simply, what happens is the number of months that a house is on the market grows. It stretches and stretches out because people are reluctant to cut the price. But eventually they kind of have to. So that's why you see it's a drawn-out process, you see, and it takes a while to work off those. And we don't know today, I think, how many people are in the shadows, and they're seeing home prices coming up, and they're looking to get in there to sell. They've wanted to sell for some time. It's interesting, about a third of home purchases are cash. And that's been now the truth for several years, and I don't know to what extent. See, the cash purchases, if those are people speculating that now that prices have come up and resell it, then there's going to be a lot of sales in anticipation of that. The other thing they may be doing is buying it and converting to rental, because the rental market has actually done quite well, because many people lost their homes, but they have to live somewhere, so they're renting a house. And it's very hard to. I don't feel easy at all about this recovery in the housing market. For one thing, it's very much fueled by very low interest rates. And to what extent will that be choked off very quickly if interest rates, as soon as they start rising? So there may be a lot of disappointments in that market, because that recovery may not be sustainable.
You and Candace going to continue to lease?
Oh, yes.
All right. Thank you very much. We have small token of our appreciation, a little glass box with our emblem on it.
Thank you.
Thank you.